Chapter 12, Intangible Assets. Characteristics. Well, they lack physical substance, they're not financial instruments, and they're normally classified as long-term assets. Valuation. Purchased intangibles we record at cost and includes all costs necessary to make the intangible asset ready for its intended use. Internally generated only include external costs. So if you have costs for accounting or legal services or patent services, but you can't include your in-house development costs. Okay, we have two types. We have limited life, and these are amortized to expense over the useful life. You credit asset account or accumulated amortization. You can do either one. And companies should evaluate the limited life intangibles for impairment. We also have indefinite life intangibles. They have no foreseeable limit on the time the asset is expected to provide cash flows. Must test indefinite life intangibles for impairment at least annually, and there's no amortization if they have an indefinite life. So let's take a look at our first example. In this case, Danny purchased a patent for $1 million on January 1st. The patent is being amortized over its remaining legal life of 10 years, expiring on January 2024. During 2016, Danny determined that the economic benefits of the patent would not last longer than 6 years from the date of acquisition. What amount should be reported in the balance sheet for the patent net of accumulated amortization for 2016? All right, first you have the purchase price less the previous amortization to the point of the change in estimate. Then you would divide that by the remaining 4 years, and you would have a reported balance sheet value of $600,000. Now let's take a look at another example. In this example, Danny bought a franchise from Alexander Company on January 1st for $400,000. The carrying amount of the franchise on January 1st was $500,000 on the company they bought it from. The franchise agreement has an estimated useful life of 30 years. Because Danny must enter a competitive bid at the end of 2025, it is unlikely that the franchise will be retained beyond 2025. What amount should be amortized for the year ending December 31st? So in this case, we would use 10 years, which is the service life, and we would use our cost divided by 10, giving us $40,000. Now here's another example. On January 1st, Danny incurred organization costs of $275,000. What amount of organization expenses should be reported in 2016? Well, all of it would be, because we always expense organization costs. All right, the next thing that happened is Danny purchased a license for distribution of a popular consumer product on January 1st for $150,000. It expected this product would generate cash flows for an indefinite period of time. The license has a 5-year life, but by paying a nominal fee, they can continually renew it. What amount should be amortized for the year ending December 31st, 2016? Because the license can be easily renewed, it has an indefinite life, so there would be no amortization, but we would look at impairment in the future. Okay, the next thing we're going to talk about is goodwill. We're going to talk about how it gets on the books and then what you have to do if it loses value. So remember, it's only recorded when an entire business is purchased, and it's the difference between what you pay and the fair market value of identifiable net assets of the company you buy. So here we have an example. In this case, we bought a company for $250,000 plus a $100,000 note. So we paid $350,000 for it on July 1st, and the total assets were $435,000, and the liabilities were $200,000. The recorded amount on all appropriate current values except the land has a fair value of $60,000, which is $20,000 more than it's on the books. The inventory value has a fair value of $125,000, which is $25,000 more than what's on the books. And the copyright, which is not on the books at all, has a fair value of $15,000. So now we can figure out, is there any goodwill? So again, we need to look at all this information. We need it in order to figure this out. And so now we're going to determine, and if you ever take advanced accounting, we spend a lot of time on consolidations. So step one is you determine, what did you give? Call the consideration. Well, we gave cash of $250. We had a notes payable of $100,000, and we had total consideration of $350,000. Now, we subtract from that the net book value, which is always our assets minus our liabilities, which was $235. So we have a difference of $115,000. Now, if the book value of the assets was the same as the fair market value, $115,000 would be our goodwill. But what we try to do is, if the assets are not correctly valued, what we try to do is assign as much of that difference to those assets, and it is only the remainder that goes to goodwill. So again, we had land that was undervalued by 20. We had inventory undervalued by 25 and trademarks undervalued by 5, which means that we have a total of $50,000 of that $115,000 that can be assigned to assets, which gives us goodwill of $65,000. Now, just so you know, if the fair market value of the assets exceeds the difference and you get a credit number, that would be treated as a gain on bargain purchase, and we would still book the assets at fair market value. Now, this is our journal entry for this. And again, the assets and liabilities are always booked at fair market value. So this would be our journal entry. And we book the goodwill. And this is the journal entry that we made if we were dissolving the company and rolling it into ours. Now, after all of this, what happens if we go back a couple years later and we find out maybe we assigned too much to goodwill? So, goodwill is considered to have an indefinite life, and it should not be amortized. And we only adjust carrying value when goodwill is impaired. And we have a two-step process. Step one, if the fair value is less than the carrying amount of the net assets, including goodwill, then we perform a second test to determine possible impairment. And in that case, we determine the fair value of the goodwill or implied value of goodwill and compare to the carrying amount. So I'll show you how this works. So in this case, Danny bought a company from Mike 3 years ago and recorded $250,000 in goodwill. And currently on the balance sheet, this is what we look like. Our net assets equal $1,650,000. And we also have PP&E that has a fair market value $150,000 higher than we're showing on our books. And the fair market value in total of these assets is $1.6 million. So for step one, if we look at the fair market value, it is less than the carrying amount. So now we need to go to step two. Step two, we're going to determine the fair value of the goodwill or implied goodwill and compare to carrying amount, which means we're going to look at the fair value of the assets, backing out the value that we have originally assigned to goodwill, and then come up with the implied goodwill. So we're going to take the fair value of the division. We're then going to show the carrying value of the division. We're going to add in the increase in fair market value for the PP&E, and we're going to subtract out the original goodwill, and we get $1,550,000, which means our implied goodwill is $50,000, and we compare to the carrying amount, which means we have an impairment loss of $200,000. And that's how we would book the journal entry. And we do not write up the PP&E. Even though those have gone up in value, ignore that. All we're doing is an impairment of goodwill. Now, the rules are the same for intangible assets with a defined life as fixed assets. So in this case, this example, we have a copyright that cost us $8.6 million, has a carrying amount of $4.3. It has expected future cash flows of $4 million and a fair value of $3.2. We're also estimating that it has a useful life of 10 years. So we're going to prepare the journal entry. First, we're going to go through our two tests. Our carrying value is 4.3. Our first year cash flows are 4, which means that we have failed the recoverability test, so we need now to go to the next step 2, which is the fair value test. And we're going to compare the carrying value to the fair market value, and we know now that we have to write off $1,100,000. So what we're going to do is write loss on impairment and take it against the copyright. And now we have a new value of $3.2 million. And we're going to divide by 10 years, which tells us our new amortization is going to be $320,000 a year. So that would be our new amortization expense. Now, the fair value of the copyright is now 3.4. Prepare the journal entry, if necessary, to record the increase in fair value. No entry is necessary. Restoration of any impairment loss is not permitted for assets held for use. So since we're amortizing it, we cannot write it up. That ends Chapter 12.